Hi guys, how you doing? I should have probably put some music on. Welcome to the Fomc meeting. Did it start? Did it start, guys? Did it start? We got a headset on first. How's everybody doing? Crypto Cartel, Farid, Hamza, Kino, Apocalyptus, up down, Big Chicken, pumping, pump. Yeah, Sasha, Florin, Big Chicken, the good guys here. Let me shield the stream a little bit before we find the live stream and watch the Fomc meeting. It's somewhere up here. Probably gonna watch it on this over here, YouTube. There we go. That's our live stream, guys. That's our live stream. Let me just shield a little bit. Okay, and on Twitter as well. We gotta do it on Twitter though. We gotta do it on Twitter. There we go. Now we have to find Fomc meeting live, something like that, right? Tom Crow.
And we were talking earlier,
guys, do you have the live stream? Do you know where I can find the live stream?
From press conference what it wants them to do, and at this point, they seem satisfied with the markets adjusting to a regular
Federal Reserve. This is the one. This is the one. Okay, 5 minutes break. We're gonna change that a little bit up here. Maybe dump hard. So everything is coming to this, guys. Everything is coming to this. As you see, I've been very active on Twitter today. Wow, the pumps, man. The volatility right now is a little volume coming in. Somebody says the volume coming in. Let's check the volume up. Yeah, the volume is kicking in up here, man. The volume is kicking in right now. So somebody maybe knows something. Maybe somebody knows something. Let's see the stock market. Stock market is actually curving a little bit on the downside. So today on Twitter I've been posting tweets as you see, I've been posting a lot today, and I've been following this pump up here. It started like this 3% move to upside. I haven't broken big resistance yet, so I've been following. This was looking like it's going a little bit parabolic up here. So but it's 5-minute chart still, but we are looking at that.
The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program,
maybe we can do it like this up here, maybe.
Decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the board and reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are
Yeah, we're gonna decrease the volume a little bit on the video until the meeting, and then we're gonna increase the volume when it actually starts.
The broader economy and the Federal Reserve's role in it. Federal Reserve Education is committed
maybe
to
0.75 next minute. Yeah, probably. So it's probably gonna be 0.5. So you know,
for more information,
we're gonna watch it. Right now, it's just going a little bit up, a little bit down. It really, you know, people really don't know what to do right now. This is on 1 minute chart, guys. This is on 1 minute chart. So when he starts talking, you're gonna see, you know, volatility on this thing over here. Do you think pump and dump? We already had the pump, so you know we can only have dump left.
What is the Fed?
What is the Fed? CNN is reporting 0.5% hike.
The Federal Reserve,
So nothing special then. So it's already priced in.
Congress created the Fed
CNN live.
I'm not going to overthink that, John. I'm going to look at the partition.
Fed rate
You know, given the supply
0.5%.
shock you talk about and the continued shocks, the China lockdown, or the separation of domestic and foreign.
Fed rises raised by
economics for
0.5.
America.
So it is
Some
as
partition
expected.
that for us,
In
and to
Fox Business, you
expect
can
the
see
unexpected is
news of
Scott
0.5%
Minor,
increase.
global CIO, always controversial.
I hope they
always
won't rise
interesting,
interest
ready
rates.
to
Man,
take
that would
notes.
make
Dodgers
Bitcoin
strong this morning.
berserk.
For those of you on radio, Mr. Minard, very much LA Dodgers right now. Scott Minard, I'm going to cut to the chase. We have to expect the unexpected, and that always speaks through the bond fixed income system. What will the
already
price
done,
of bills,
0.5.
notes,
Okay.
and bonds do?
News already out. Okay, so news already out, but what's not out yet is the conference after the thing, right? That starts at 8:30, so in 22 minutes, if I'm not mistaken, and that's the important thing because he's gonna talk about you know, future prospects of inflation and stuff like that, right? What they're gonna do, you know, you know, in the future. Priced in, so guess not a huge pump, but also not a dump. Yeah, 0.5 was all priced in long ago. So you know, right now that we have this confirmed, I think markets are a little bit relaxed. You can see that, you know, the Dow Jones is you know, doing 0.44%. ESP is also 0.44%. This is 1 minute chart. Let's go to 5 minute chart up here. You can see here it started going down, but you know, it kind of climbed back up there a little bit up here. It's been climbing slowly towards the upside up here. Maybe some kind of a rising wedge up here on the 1 minute chart up here. That's a very ugly rising wedge, but there is some kind of, it's actually expanding wedge up here, give or take. Maybe some kind of expanding wedge up here on the chart. No, it should not go. It should go from over here down there, something like that. Those are some kind of expanding wedge, rising expanding wedge. So it is a some kind of bearish, you know, continuation flag up here. But we're gonna see how that is gonna. Which hour he will talk? Fed. He's gonna talk in 20 minutes, from what I heard. So if you see here, Fomc meeting time and Fomc meeting time. 4:15 press conference. Maybe it's 4:15. Yeah, maybe it's in 5 minutes. Looks baked, bad outlook. So today is the Wednesday. Fomc meeting, 2-day meeting, 34 press conference. So this is it's the press conference we are waiting for, because that's when he will announce the you know, what the future plans are, and that can actually affect the price, because you know, the interest rate 0.5%, we already kind of knew that, and you know, that should become pretty quickly, and already came out like 0.5%. So right now it says 2:30 p.m. Eastern time, so that's actually in 19 minutes. June 1st runoff of 47.5 billion, month-to-month reach 95 billion month after 3 months. Yeah, I also heard that. I think also that's priced in a little bit, but not quite sure what that means for the price. 0.5. 8:30. Yeah, 8:30. So right now it's 8:11, at least here in Norway. So yeah, 19 minutes left, guys. 19 minutes left. Let's watch the charts a little bit and what's been happening with Bitcoin while we are waiting for the press conference. And as you can see on the 4-hourly time frame, which is very exciting, is that we managed to break this 50 moving average up here. So, you know, 50 moving average, resistance, 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 and right now we are breaking it, but we are still, you know, hovering just above the resistance over here. And I think we are waiting for this press conference to end. And once, you know, the press conference comes out and, you know, some stuff are confirmed or not confirmed, we'll either continue, you know, move towards the upside, or we'll dump on the downside. So, you know, how this actually gonna play out, I'm not really, you know, the best guy to, you know, comment on this, but, you know, we do what we can do. The thing that looks nice on the daily time frame is that we have some kind of double bottom down here. You can see here the double bottom being created down here at the bottom here. Also, if you can close today above 38,518, that will give us a bullish engulfing candle, and this bullish engulfing candle above the 10 moving average should be very, very bullish. So I'm looking at continuation towards the upside in case we can actually close up here somewhere, right, on the daily time frame. And now the daily time frame still got something like 5 hours and 46 minutes left. So, you know, it's a long way to go. It's a long way to go, but, you know, these first moves on the 4-hourly time frame does look, you know, promising right now, and this can, you know, technically, you know, bounce, you know, really hard towards the upside once this actually plays out. Let's see here on the 1-hourly time frame, we got a small bearish divergence up here, so maybe a move to the downside can happen. If you move to the downside without any kind of divergence, that might be bad, but, you know, we'll continue watching the charts. On the 4-hourly, we don't have anything right now. Everything is playing as it should be playing out, so, you know, that is good. And on dailies, everything is playing, you know, it's just this 1-hourly time frame that's a little bit tricky right now, because we do have divergence on the chart up here. Now the divergence already played out, so technically we can continue towards the upside up here, but I think we still need to wait a little bit how this unfolds and how it is. Daily affirmation, Farao Verpil, how you doing, man? Yeah, I'm gonna watch the press conference to see what they're going to do next month. Love the music, anticipation building, the moon is coming. Yeah, it's not my music, it's Fed music. But, you know, at least we got some kind of background noise. The music is too high on video. How can music be too high, man? You can almost not hear it, man. Let me double check that. So we're gonna stop this music and we're gonna open it up here. Your channel. Daily time frame. And now the daily time frame still got something like 5 hours and 46. Nah, music is okay, man. I don't know what you're talking about. It's so low, man. It's so low. Yeah, music's fine. Whales are greedy. They want you to believe that it's already priced in and dumb asses buy. I won't buy back until it until we break 48. Yeah, I'm with you, man. I'm not buying until we are above 100k, man. It just you know, fake out towards the upside. Fake out towards 100k, man. Do you smoke weed, bro? No, I don't, man. I'm pretty much against that, so, you know, don't, you know. You pull a 9. Upola 9. Music is fine. 15 minutes. The music barely audible. Yeah. You know, background noise is fine. Background noise is fine. Be Pro. Shiba Inu up 2.9%. I think, you know, ApeCoin is very interesting. And I was watching ApeCoin since down here. I thought it was the bottom. It didn't. It did break the trend line up here, but it got you know, resisted by this secondary trend line. It created a secondary trend line up here after this top up here. And you can see that this secondary trend line came up here. So we broke this secondary trend line up here, and I was thinking, oh man, this might be a good time to buy, and it went up 20%. But it did pull back a lot, and right now it's still climbing up here. And I can see here up over here right now. It is above this trend line up here, man. It is above this trend line. Where is this trend line? You can see it came back above the trend line. Right now consolidating up here. So I think, you know, ApeCoin might continue towards the upside. What website to do Fomc, please? We are just watching the Fomc meeting on YouTube. Just search like Fomc meeting live or Fomc press conference and you'll find it. When do we play territorial again? Never, man, never. It was, you know, I still do play territorial, you know, but it kind of got me boring a little bit. We're gonna drop later. We're not quite sure. We're gonna look at the press conference, see, you know, what the people say around. There have been nice moves today. Waves is up 70%, Zilka is up 20%, Cyric is up 13% right now. Let's see up here. We got Pyro, whatever this is, up 12%. So there are definitely some coins that have, you know, had a decent pump towards the upside right now. Cardano is also did you know, 8% move towards the upside. Up here you can see here it is breaking out of this this falling wedge. It looked like a fake out towards downside, right? It looked like a fake out towards downside, came right back in, and right now it's going towards upside, other side. So it does look a little bit bullish. It does look, I gotta admit, it does look a little bit bullish. Zil pumping again. Yeah, Zil pumping again. Was there a lot of volume with the current pump? To tell you the truth, I haven't watched the volume on the daily time frame or anything like that. But no, there is not a lot of volume up here right now. So far, it does not seem that volume is kicking on the daily. Let's see, but you know, the 4 hourly, not much yet, not much yet. It's still, you know, it's still trying to, you know, break certain levels up here. It's already breaking certain levels, but you know, we are still on the 4 hourly time frame. So you know, I don't know if that's enough. I don't know if that's enough. Is the Fomc same day every year? No clue, man. I don't think that is. It's good tradition that we need to be invented. Every stream ending one game of tutorial. Nah, I thought I should do that, but you know, I figured out, nah, it's not gonna work out. People don't come here to play tutorial. But it was fun while it lasted. It was fun while it lasted. This Verbund, ERA 8% up today. Yeah, ERA did nicely. ERA did nicely. We all gonna make it, yeah. Love you, man. Love you too. This time next year, everything will be all right. Yeah, everything will be all right, guys. We're gonna do a little bit research on, you know, small cap coins and see how did they perform in this bull run. Because you know, you have to ask yourself, will there ever again be another Bitcoin bull run? If the answer is yes, you know what to do, guys. You know what to do, because doesn't matter what the price of the coin is right now. On that bull run, if it's not some kind of S coin that's gonna die in the next couple of months, that coin is gonna surpass whatever the price it is right now, right? Remember that. Ask yourself, is there ever gonna be another bull run in Bitcoin? If the answer is yes, and tell to yourself, ask yourself, do I believe that there will ever be another bull run, Bitcoin bull run again? If the answer is yes, then any kind of coin, any kind of altcoin that, you know, it's not total shit bag, it's gonna surpass whatever the price is at now. Remember that. Fomc, fear of the market crash. You're going to the moon, we're gonna have wave the moon. I need to take this off, it's too hot in here, man. Sorry about that. I hope I don't get banned. It's a good thing we are not on Twitch. Tap the like button, guys, if you like that. Girls as well. Okay, good thing we are not on Twitch, you know. Instant ban, man. Instant ban. Is anybody here good with computers, guys? Is anybody here good with computers? Because I'm just about... I'm about to buy a PC, guys. I need a new PC because right now I only have 2 screens, and the problem with 2 screens is I always got too much on the I always got too much stuff on the screens, and so I want 4 screens. So I need a bit better graphic card and so forth, right? So I'm gonna buy a new PC because this PC is right now, I think it's around like 10 years old, a little bit less than that. So it's, you know, I already changed the graphic card in this one to GTX 970, so it's working really well. But you know, I don't play that many games, you know, but I do want to do, you know, video editing, and you know, if some, you know, good games, new games are coming out, you know, I want to play on Ultra and stuff like that. So I'm gonna buy a new one. So you guys tell me if this is a decent, you know, PC. Where is it? Can we look at it over here? Yeah, I'm just gonna copy this over here so we can look it up here maybe. We still got, you know, a little bit time, 8 minutes left. So this is the PC. This is from Complete, and it's 25,000. It's in Norwegian crowns, you know, it's Norwegian crowns. But what I was wondering, the graphic card that follows this PC is a GeForce RTX 370, but I was thinking I'm gonna, you know, this is over. I think RTX 380 Ti, like 14,000 extra, I think that's overkill, you know, because I mean, why would I go there? But I read that, you know, these 3070 cards are like for regular people, like you know, yeah, 370 is nice, but 380 is not that much more expensive, right? So this one, RTX 380 Tough, I mean, it's not much more expensive, and from what I saw is that, you know, high-end games, 370 gets like 160 FPS on, you know, high scales, while you know, RTX 380 gets like 250 FPS. Yeah, 370 is fine. I know it's fine, but you know, I was thinking like 380, like 2,000 bucks. How much is that? That's like 200 bucks, $200 more. Go with 380 Ti. If the price difference is too big, you're gonna be future proof. Yeah, the problem is the price difference is very big. It's like 14,000 price difference from 38, and I really don't need, you know, I'm gonna do, you know, video editing, I'm gonna do, you know, high-end games, you know, but only from time to time when, you know, something new comes up, then I'm gonna try it. I don't play games anymore. I play tutorial. I mean, you don't need 3080 Ti for tutorial. 3070 might be obsolete in 2 years time. I don't think so, man. I bought I mean, it's gonna keep up. It's gonna be future proof if you can afford it. I mean, I can afford it, but it's really just too much for a card, you know. So I was thinking 380. That's fine. That's fine. So I'm thinking I'm gonna change 380, and that's gonna be fine, right? 380. Now, when it comes to, you know, video editing, what I heard, you know, you want a lot of cores and you want a lot of threads. So the one that follows this PC is 5800X Ryzen 7, right? But it only has 8 cores and 16 threads. So I would change it to something like a Ryzen 9 5900X, because it has 12 cores and 25 threads. So I was thinking, yeah, maybe that's a better, you know, pick, because it has more threads. So I don't know how good that is for editing. Yeah. So 5900X, because it just has more threads, it has more core, and I read that, you know, video editing, that's actually, you know, good stuff, right? You want as many cores and as many threads when it comes to video editing, right? 200 extra is no brain, dude. 370 press won't be absolutely released, but yeah. Let's get some extra a little bit. Ron, 249 bucks. Thanks, Ron. Appreciate it. Right into the TA Fans Club, you know, account box. Thanks, man. We're gonna, you know, 1000x that. 1000x that. Yeah, so I'm gonna getting this sphere. Now, when it comes to the cooler, I really don't care. I don't think this has any kind of difference. So, you know, I really don't care about that. When it comes to memory, and here or the one that follows is 2 times 8 gigabytes, so that's 16 gigabyte, 3200 megahertz memory. But I was thinking like 16 gigabyte for video editing and maybe a little low. So maybe going for where is it? 32 gigabyte. Because I was thinking 32 gigabytes is maybe a little bit better for video editing. Like, I still think, you know, 32 megabyte is still overkill, but you know, I think it's okay. Middle of row without paying too much for some extra performance. Yeah, 38 is fine. 16 cores. Yeah, but they don't have 5,950. They have, because I can only pick, because this is complete. I'm not building it myself, you know. So it's a semi build, you know. So I don't have to do the work, you know. I just pick whatever they have, you know, for that PC, you know, and that's fine. But I don't think they have 5,950. Yeah, they do have 5,950, but it's $400 more. 32 threads. Yeah, it does have more though. It does have more threads. 16 core and 32 threads, maybe. And yeah, that's the only thing that I was wondering about. And when it comes to SSD, so you know, 2 terabytes, that's the biggest they they have it on the list, and it's 7,000 you know, read write. So I'm thinking, you know, that gotta be good, you know. So it's fast enough. It's fast enough. Is it okay PC for video editing and, you know, high-end games? I think it's okay for a new video producer machine. Yeah. So 3 minutes left until the Fomc meeting. So I think this is gonna be fine, you know, because, you know, I want 4 monitors. I want, you know, do video editing. Any M2 is fine. Yeah. So I read that, you know, the M2 is the next big thing, right? Yeah. So I read that the M2 is next big thing. So any M2 is fine. And this is M2, 2 terabyte. I don't know why it says PCIe 4, but, you know, it's 7,000, you know, it's only right now in the list that's, you know, 7,000, you know, read and write. Good. Need and motherboard also. Yeah, the motherboard, I'm not quite sure, because I'm not quite sure what, you know, what to pick when it comes to motherboard. You know, the way I look at motherboards is, you know, what can I put in there, right? So this has, you know, the one that follows over here is ROG Strix B550. You know, it got some kind of M2 slots, AM4 ATX, PCI 4. It's also got a Wi-Fi, so I don't have to, you know, get additional Wi-Fi for that. But the only thing they have over here is B550 Pro, Strix B550E. This is tough gaming. Strix 570. They got MSI 550M Pro, Asus Prime B550 Plus, Asus Prime X570. But I absolutely no idea what to, when it comes to motherboards. I only pick like what can I put in there. X570 motherboard is the best, brother. X570. So the one that follows is XB. Yeah, here's the thing. I was thinking to go for X570 because I was looking at YouTube on the videos. But somebody says that, you know, the X570, what was it? It doesn't come with a Wi-Fi, and there was also one more thing, you know, that was lacking in a 570 over 550. So I thought, yeah, let's just leave it at 550. But, you know, I heard that people are saying that 570 is better than 550. But not sure why, But there was like this one thing, so I'm not quite sure. The price difference is not that big, just like $80. So, you know, I could go for 570, but there was this one thing, I think, I don't remember. B550 is the way to go. 1 minute left. Check the space sometimes. Yeah, okay, thanks for that, guys. There we go. The press conference is about to start. So we gotta go back to the press conference, guys. And let's go to 5 minute chart. Maybe 5 minute chart is gonna tell the tale. So we're gonna keep on seeing what's happening up here. Still nothing happening on the press conferences. It can take a little time. Mumbo jumbo emergency. Make sure it has M2 slots. Yes, everything has M2 slots right now, I think. At least the new stuff. B550 has 99% of the features of 570, but the B550 chipset only consumes 5 volt of power, and 570 chipset consumes 50 volt of power. Why add 10 volt of extra heat for no reason? Yeah, there you go. Thanks, man. You made my life simpler.
Good afternoon.
There we go. We got
nice
a power.
To see everyone in person. The first time
So
in a
let's
couple
see
of years.
what he has to say.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
I think we heard about this.
After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well.
So that's bad.
Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings.
Wow, they're going to increase by
We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy.
Next couple of meetings.
And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Yeah, the questions are gonna be interesting. But he didn't say anything that bad. Like everything that he said was already kind of priced in, the 0.5%.
Nick Timmeros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right, 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation.
When job creation
Implications
goes
for
down?
inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up. because vacancies are at such an extraordinarily high level. There are 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
Yeah.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But
the green candles are just popping,
again,
guys.
It's not like we would stop. We would just go back to 25
Almost
basis point
4%.
increases. It'll be a judgment call when these meetings arrive. But our expectation is, if we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Thanks. Let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
Pumping.
So, neutral.
4% back up to 4%.
When we talk about the neutral rate, we're really talking about the rate
200
that
people,
neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You know, you're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions.
It's not off the screen yet, so it's okay.
And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil. Thanks, Chair Powell. Neil Irwin with Axios.
There you go.
Do you
You're
see
going
evidence
off the chart.
that
We're off the charts, guys.
inflationary
We're off the
psychology is
charts.
changing, that in areas like workers' wage demands,
No, we
businesses'
still make
willingness to raise
charts.
prices? Do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market, where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks then, but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chain, in supply chains healing. And so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
Victoria.
So it looks like optimism is back.
Hi, Victoria Guida from Politico.
On the table,
I
guys.
want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. Two questions, one quick one.
Yeah, everything is.
You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see?
This
that
removes
come
a lot
down
of uncertainty in the market. I think that's what market needs.
Vacancy to unemployed rate. And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Well, you don't want me. Yeah, we are looking.
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance, and that depends not only on the level of those things. It depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, What is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So, the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities.
Look how nicely correlated it is.
Wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier, just now, fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
You know, it's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity, we take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there. And we look at it as our job to, given all the factors that are happening, to try to sustain maximum employment and price stability. So if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that, stick in our lane.
Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. Wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. And I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. This is, we have a pandemic, we have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side, and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have numerous supply shocks which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber at Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. You know, the point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, you know, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
So what does this last thing mean when he said
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, you know, and that happened to be the date that we picked. It was nothing magic about it. We you know, it's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I mean, I would just stress how uncertain the effect is of shrinking the balance sheet. You know, we run these models, and everyone does in this field, and make estimates of what will be the how do you measure, you know, a certain quantum of balance sheet shrinkage compared to quantitative easing. And, you know, these are very uncertain. I really can't be any clearer. There won't be any clearer. You know, people estimate that that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And you know, our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes. I want to remind us, really, that that's who we work for, and that it's inflation that people are feeling all over the country. And it's very important that they know, that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that. And so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that, so in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, you know, very appropriately, not to bless any particular day's measure, but the way financial markets, you know, the forward rate curve has tightened in response to our guidance and our actions really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points. And that's all through the economy. People are feeling those higher rates already. And so that shows that the markets think that our forward guidance is credible. And I think that's, we want to keep it that way.
Scott Horsley, did you have your hand up? Okay. Brian, Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Greg, Rob.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got 3 or 4 really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see, unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing, and it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
There we go, guys. I missed the ending. I hope I didn't miss anything big. I hope he didn't say like, I don't know what. Then here we go down again. So that's it for the meeting, guys. Now we're gonna look at the price of Bitcoin, and this is 1 minute chart versus DXY. DXY is this orange line, and you can see that they are very tightly correlated though. When the price of DXY goes up, when the dollar goes up, the price goes down, but when the dollar goes down, the price goes up. This on 1 minute chart, so they are very, very tightly correlated, guys. Look at the correlation here. So right now it's picking back up a little bit. Let's just go and check out. Let's just go and check out DXY right now on the daily. And you can see here this big move towards downside. This was kind of expected because we have been, you see our trend lines, guys. You see our trend lines. The top here at 103 is already hit. The top at 103 is already hit. That's when we call the top up here. There was a resistance, there was support, and you can see here we failed the support down here, closed down, and it started going on the downside. Right now we are picking a little bit back up again, so Bitcoin might have a pullback if this continues to go towards upside a little bit up here. But yeah, very tightly correlated with Bitcoin, definitely. Tila, best news of the day. Valenza is going to make Dodge Daddy a hardcore remix. He just needs the source song. It's in the description down there. It's in the description. I can pick it up. Where is it? Dodge Daddy. There we go. That's the link to Dodge Daddy. So let's check out a little bit what Bitcoin is doing right now, a little bit bigger time frames than 1 minute. Let's clean up everything up here, a little bit up here. So, this falling wedge looks like we are broken out of the falling wedge. Now this needs to close like this on the daily time frame. We still haven't closed, so there's that. You can see here we are breaking towards upside up here. We have been hitting support right now. This Fomc making happen. Everybody, that was the thing that we have been waiting for, and right now it did happen, and we are breaking towards upside. Now this needs to stay up there as well. If you look at a 4-hourly time frame, we did stay up here and we bounced off of the moving averages down here. So this looks very strong. This looks very strong. We are hitting the resistance here at 39,983 on the 4-hourly time frame. 4-hourly time frame. Let's see on the daily time frame as well up there. Daily resistance is at actually a little bit lower than that at 39,742. But we are above the 20 moving average as well. This is a bullish engulfing candle above the 10 and 20 moving average. You know, still 4 hours left. We still got 4 hours left and 38 minutes left on this this candle up here. But it does look very bullish and very good, guys. It does look very bullish and very good. Cardano is up something like 12% right now. Let's go to daily time frame. Cardano is up 12% also outside of the wedge, hitting the first resistance on 20 moving average up here. Ape, where is Ape coin right now? Ape is still at 6%, not actually moving that much. Ape is not moving that much, but it is breaking this resistance line up here right now on the 4-hourly time frame. So maybe it's gonna move very soon. And there are of course other coins that are, you know, 10 plus. DYDX Eagle is up 10%. You know, a lot of stuff is up a lot right now. BPro, you know, the CoinSkid coin is up by 17%. So it does look good, guys. It does look good. Cannot lie, cannot lie. Bullish. I take profit by 35. Chocoban 100% rotation is coming. So this looks very good for the price, and altcoins right now break to the upside out of the falling wedge is very nice. The target should be around here up at 41.5 give or take. That's what we are at least you know, looking at right now. The 50 moving average as well. If this actually can be sustained, you know, throughout today. Still 4 hours and 36 minutes left on this last candle up here. But if you can sustain, you know, this bullish engulfing candle, this double bottom down here, this double bottom, you know, with falling wedge and the support down here on the bottom up here, breaking out of that, we need to look at this 41.5 level up here. If we can manage to get above the 41.5 level, you know, that's you know, big bullishness is gonna kick in, so you must see big moves. Total 2 broke 1 trillion market cap again, so that's also good. Was the Fed meeting good? Yeah, the Fed meeting was actually you know, with expectations, but he didn't say anything negative. The way from what I got, you know, and I do not understand the, you know, economy that well, he didn't say anything that bad. He didn't say anything that bad. But I do also know that, you know, politicians do tend to lie. I'm not saying he's lying or anything like that, but, you know, maybe he's not saying everything. You know, and what happens in the future, you know, that's for future goal, because, you know, suddenly it can be, you know, okay, inflation is going rampage, you know, we need to do 0.75, and suddenly we're gonna be bearish again, right? That can definitely happen. But right now, it is bullish. It is move out of this wedge on the bullish news right now, and you can also see that for example, S&P 500 is also up like something like 2.25%, and Dow Jones is also up like 2.30% towards the upside right now. So we have been hitting these bottoms down here, and right now we are bouncing off of these bottoms. Unfortunately, DXY, for example, is not above very important resistance around 34,000 levels up here, and S&P is just barely making, you know, move above the 10 moving average, and still has these, you know, lower highs, still lower highs down here. But it does look like some kind of double bottom down here on Dow Jones and S&P as well. Some kind of double bottom down here as well. DXY is going down as expected. We have been calling this stop for a while now. After this stop happened up here, we have been thinking this might actually bounce. It didn't bounce. It broke that towards downside. It tried to go up here, and you know, the probability was, you know, 44, 45 as well. It didn't do that. It hit this resistance up here several times, failed that, and right now is breaking down support. So technically this should you know, correct towards downside. You can see here on the 4-hour time frame that we are also below the 50 moving average down here. So I'm looking at some kind of, you know, down here back at some kind of 100 level down here, because there is a very important support line down there. So as long as DXY goes towards downside, we can expect Bitcoin to go towards the upside, right? That's what we can expect to do right now. And you can see here how this actually looks. This is the you know, support line, the trend line down here. Maybe it goes a little bit up here. Maybe I have drawn a little bit differently. Maybe it should be something like this up here. as well, you know. But I'm looking at 100, yeah, so let's say 101, 101 down here. That's the target for this move right now on the downside after it broke the trend towards the upside. So DXY looks good, stock markets looks good, Bitcoin is pumping 5.5%, altcoins are pumping, everything looks nice. There is no problems in paradise right now. And you know, the question right now is, are these, you know, big resistance level like this over here, 39,742, are we gonna break these big resistance levels towards the upside? You know, because on the way towards the upside, I mean, we have been trading, you know, up here for a very long time. There are a lot of resistance line that needs to be broken, a lot of important ones that needs to be broken as well. But the more resistance line we break on the upside, the more bullish we can actually get, right? So right now we are looking at this very first move towards the upside after this Fomc meeting, and it does look good, guys. I cannot be bearish right now. It does look good, but this is the weekly time frame, and you can see here very important resistance here also at 41.5 up here, 10-20 moving average, you know. So it is a small win, small move towards the upside, but it can turn into a big win eventually. We have been also talking about the monthly moving averages, and this monthly break on the downside down here below the support as well, without any kind of divergence or anything like that on the chart. MACD is still going towards downside, and for some reason, you know, if we want to be any kind of bullish this month, we need to break 41.5. You can see 41.5 also, this very important level on the monthly time frame, this 20 moving average. When we came down here, we have been talking about that, you know, the move up here to 41.5 is technically very likely, because, you know, oftentimes you come to retest these levels before you continue on the downside. You can see that you know, monthly time frames most often have both bottom and upper shadows, because the price moves so much. But what you're gonna see here is that we don't have any bottom shadow on the price previous month up here, which is quite bearish, quite bearish. Now this move towards the upside is expected. The bearishness is still in play up here, but right now short term it does look good. So when something changes, when we hit this 41.5, maybe 41.5 up here, also 200 moving average on the 4-hour time frame, when we hit some kind of 41.5 up here level towards the upside, we're gonna have to see how it actually reacts to that level. If you can manage to break that level towards the upside, that can actually be very good for the price. But right now, you know, we're gonna take this small win, we're gonna roll with it, you know, we're gonna see how altcoins are, you know, performing, and so forth. You know, enjoy what you can, man, enjoy what you can. By the way, we got a new TF Fans Club member in the chat, Mikhail Miko. Welcome to the TF Fans Club. Enjoy the green name, enjoy the emojis, and since this is your first day in the club, you gotta pick the coin. Do you want me to look at anything right now, man? I started my short at 40k. 100k June, let's go. Impossible to dump with this news. Top is in. Top is in dystopia. Good name, man, good name. It fits with your comment. Or 55k. I don't know. 55k is pretty high, especially if you look at a monthly time frame. I mean, 55k up here, that's 46. I mean, 55k, that's extreme bullish territory up there. So I'm not quite sure about 55k. Now, yeah, anything can happen, but we are never looking at, you know, too far ahead of time. We are only looking at short moves, daily moves, you know, short progress. Because after a certain amount of time up here, you know, you can maybe predict this, you can maybe predict that, but you know, when you're looking at a long-term time frame, right, and you know, predicting what's gonna happen here, whether we're gonna do something like this or do something like that, it's really difficult to predict, you know, long term. So we are always looking for the next move, what's gonna happen next, are we gonna go up, are we gonna do down, is this bullish, is this bearish? That's why it's very important to follow the, you know, the trends, to follow what's happening right now, and so forth. So right now we are out of this very important trend up here. So there was this trend up here, give or take something like this up here. You can see here we are breaking that trend. So this downtrend up here right now, technically it is being broken, which is quite nice. Let's go to the 4-hour time frame. We already had a retest on that trend up here. That was the retest. We got the retest on the 4-hour time frame, so technically we do not need to go back and retest this. We technically had a 2 retests down here, a 38.6 on this trend line down here. So technically we do not have to have another retest on the downside. This can definitely just go all the way up to, you know, 41.5 or whatever it's going to go up to, and then it can, you know, consolidate, and then we'll see the next move, is it towards downside or upside. But these levels are right now that we are hitting right now, trying to break. They are very, very important, so forth, so forth. The trend hasn't changed now. The trend hasn't changed for now, only a relief pump. No, the trend, the daily trend has changed, definitely. 100%. Now weekly trend is not might not be changed, but the daily trend has definitely changed right now. So this move towards downside, ever since, you know, we hit some kind of 48 levels up here and start going towards downside, this has been a trend, and right now we are breaking that trend. So trend right now, it's definitely changing. You can see this on the daily time frame. So this trend up here is definitely changing right now, if we can manage to close this candle up here. So the trend change is definitely in right now. Now if you look at it on the weekly time frame, is the trend changed yet? Now this short-term trend over here, you know, maybe it is it is changed, but you know, we should probably look at, you know, long-term lines up here. Now the first trend, when we actually broke, it was actually something like this up here. So you can see here we had a, you know, one trend up here, we broke that towards upside, we retested that, and right now, you know, create a new high up here, and then we went back down. So this trend that we broke right now, it's only short-term trend, it's not any kind of big term trend. There is another one down here that's around 50 moving average up here, so that's going to be around something like, right now that's around 44k, you know, next week that's going to be around 43k. We need to break that as well, and continue towards the upside. But the good thing is that we are indeed breaking trends right now. You can see also this trend up here that we had over here, that's also broken. This retest on that trend right now. You know, everything, you know, trends are being broken. The bottom seems to be in right now. But you know, we need to get above certain resistances. It's often it is very late, you know, waiting for some kind of confirmation and then getting in, because by the time confirmation comes in, you know, it might already be too late, and a reversal might be happening. But right now, you know, it does look okayish. The very bullish line up here is something like this up here. I'm going to show you just so you guys know. So if you for whatever reason starts popping up here, you know, some kind of 51 52 levels up here, and break that towards upside, and that, you know, depends on where you can, you know, 52 levels give or take, 52 53 levels, if you can get above those levels up here towards upside, that's going to be extreme bullishness, because you are breaking a trend line, not downtrend line, you're breaking uptrend line, which should increase price movement towards upside. So, you know, Chaco Ben saying, you know, we're going to go up to 50 where is it, up here 58, and then we're gonna reverse. Not that I don't see that happening. There is no way that can happen because of this trend line, because once you break this trend line towards upside up here, you know, you're gonna increase the speed towards upside, bullishness is gonna kick in. So I definitely don't see, you know, any kind of reversal on the 58k. That said, right now this does look indeed very nicely. As you can see, we are still below 1020 and the 50 moving average on the weekly time frame. On the monthly time frame, we're still below certain levels up here, you know. So you know, right now the target is around 41.5, give or take. You can also see 4-hourly time frame, there is 200 moving average up here as well. There is definitely a lot of resistance up there, but you know, this move towards the upside right now, it is breaking already this first. So we had, you know, some kind of, you know, high, lower high, lower high, lower high, all the way down, and right now we are getting a higher high. So this is like some kind of high, and this is higher high. So we are definitely changing the trend. So the next thing that I would expect, maybe move towards the upside a little bit, and then some kind of pullback towards that, so we can get low and higher low as well. Once these two things are actually confirmed, we are technically some kind of uptrend on small time frames, like 4-hourly time frames. But it's okay, because you know, these small time frames turn into the, you know, bullish into the bigger time frames eventually, and you know, everything, you know, works out. On the daily time frame, this 50 moving average must be also looked. So you see right now 41.2, 41.5, 41.9, give or take. This is the big resistance level right now for this falling wedge, the way I see it. If you get rejected by these levels and fall back down on the downside, maybe back down to 37, 38 levels on the downside, that's gonna be, you know, very, very bad move. And if you do that, then I can say, you know, with, you know, high degree of confidence that you're gonna see very low levels after that, I don't think, you know, we can, you know, sustain another, you know, rejection and then back move to these bottoms down here, because if that happens, I think we might see very low levels after that. after that. So right now that we are a little bit bullish and going towards the upside up here, I would like to see us getting above these levels up here towards the upside, and if that can happen, you know, we're gonna definitely have the bullishness enough to maybe even try to go higher. But this level up here, you know, whatever that's gonna be, 51, 52, 50,000, depends on where we hit that resistance line. This resistance line at the top up here, very important resistance line for the continuation of the bull market, not continuation, you know, new bull market, but we need to get back up there. We are not even close to that right now, so you know, it doesn't pay to actually talk about that. But right now, you know, this is the major resistance, 41.2, 41.5, 41.9. That's what I'm looking at right now. And you know, if we can manage to get above this first level of resistance, I would assume that we are very bullish. But if we start getting rejected by that, you know what I think about everything else. Who wears shorts? Bull trap is such big volume? I don't think so. No, I didn't say it's a bull trap, you know, because if you go all the way up here, there's no bull trap. This wedge down here, this wedge that we had, this falling wedge up here, the target for the falling wedge is always top of the wedge up here, and top of the wedge is not up here. This isn't the top of the wedge. This wedge started somewhere around here, and you can see that target for top of wedge is around 42k. So right now, you know, only way this can be some kind of fake out. Only way this can be some kind of fake out if we, you know, reverse right now towards the downside, right? So right now we just reverse towards the downside. That's a fake out. But if you go to the 42,000 levels, you know, you technically played out the wedge, and then you can reverse towards downside without actually being any kind of bull trap or anything like that, right? Because you know, you hit the target. I think we need a god candle, otherwise I fear dump may come. We still got the new moon kicking in, so you know, moons, like somebody said, you know, they got a like 80% chance to play out. Right now, this actually playing out towards the upside, but we'll see if you know, by the end of the moon. That's the question. This full moon up here, from the start to the end, it actually went down. But every other moon, not every other moon, but a lot of other moons from the, you know, from the moon to the next moon, you know, the price in average change towards, you know, in the right direction, right? So over here, this is actually very bearish. You know, this is a full moon. It should have pushed us towards the upside. The fact that it was pushed towards downside is kind of bearish. Now this next moon is not gonna play out until, you know, 14 May or something like that. So you know, if we go up here and then you know, continue downside, this technically still, you know, closes below wherever we start up here, technically it did play out. So just because we don't go, you know, straight line up, you know, we, you know, new moon up here and straight line down, doesn't mean that it's not playing out, right? Doesn't mean it's not playing out. You know, you gotta give it a little bit time. Time. Just 2 profits good enough for me. We'll sit it out. Bridge cable is at least very good at taking profit. Where has coin seems to disappear when we're bearish. No, I've seen him around. You know, he also has his Discord he's taking care of. He's been on vacation lately. You know, right now it's very nice time and he has a lot of money, so you know. Studies carries out on the effectiveness of candlestick patterns seem to agree that overall the patterns are successful 50% of time. Mumbo jumbo, don't be so bearish, guys, on the monthly. Mumbo jumbo. The guys that did the study cannot do TI, so you know, they don't understand the bearishness and bullishness. So you know, don't trust the studies, man. There is always some study and some statistics. They're gonna, you know, show whatever they want to show. I can definitely create a study on candlestick pattern to show that, you know, it is more than 50% correct. So there's that. You could sell everything just when the bull market starts. Yeah, exactly, man. I am the inverse indicator, man. I'm inverse indicator. So right now the bull market is starting, guys. If this right now plays up to, you know, to kind of some kind of 200,000, something like that, no wick on the monthly and still pump. Yeah, no wick on the monthly and still pump. But you know, we did pump on the news, guys. Remember that we did pump on the news right now. So you know, nothing is, you know, played out yet. It does look good. It does look nice. The targets are, you know, somewhere up here. We are already right now hitting this 4-hourly target up here that we cannot break yet. So you know, if we fail to even get up to you know, to this level up here, I would assume this is very, very bearish. So, you know, at least up here to, you know, regain some bullishness, 40K, reject that 40K. Not yet, it's too early, We are still up 42% right now. And we are not technically rejected, we just are hitting the target, so, you know. TILA inverse indicator is famous. Yeah, I'm the inverse. When I get into the fear, it's probably the bottom. When I get too bullish, it's probably the top. Look, this going hard on the monthly, no weekly, monthly, and still pump. Yeah, we just talked about it. Rafael spitting facts. And but now what happened to Coinskid? Nothing happened, man. He's still posting videos, man. Nothing happened to Coinskid, man. Coinskid. Videos. This is 5 days ago, 5 or 6 days ago. No, nothing happened to him. He's still around, but, you know, he doesn't post that much when, you know, because he's not getting any subscribers, you know. He making most of the money on the Patreon, you know. He doesn't care. He's on holidays. Yeah, he was on holidays. I don't know if he's still on holidays. Hey, talk about XRP too much. That's the issue. He's talking. Yeah, maybe that. Anyways, guys, this has been almost a 2-hour live stream. So, you know, the FOC meeting is done, guys. The FOC meeting is done. So yeah, we are a little bit bullish, at least short term. So, you know, let's keep it that way. If something changes, I will keep you updated. Until then, you know, thanks for stopping by, guys. Thanks for the new member, Mike. Welcome to the TF Fans Club again, and everybody else. Thanks for stopping by. If something major happens again, we're gonna again live stream as always. Subscribe to the channel. Hit the like button on the way out, guys. Hit the like button on the way out. Yeah. And with that said, guys, enjoy the pump song. TF Fans Club. Goodbyes. Thanks for my donation. Yeah, thanks for the donation. Yeah, I saw some donations in the chat. Mr. Maloney, 199. Go Dodge Daddy. Yeah. Don't finish. What is TF Fans Club? TF Fans Club. You get the green name. You get the emojis. You get to be the part of the club. Also, we got a weekly live streams only for members where you can ask questions and stuff like that. The green names, guys. The green names. Anyways, guys, thanks for stopping by. See you tomorrow, Bitcoin Daily, 9 a.m. Central European time. 9 a.m. Central European time on the dollar. Bye-bye.